Hey everybody, today I'm doing an update on Sprouts Farmers Market, ticker symbol SFM. They came out with their earnings release for the second quarter just in the last 2 days, and I've been bombarded with questions on how I thought the earnings went overall. We saw a dip in the stock price, so I'm going to give you guys my personal opinion on what I think of the earnings overall and the future of Sprouts. And if it's the first time you've watched one of my videos, my name is Justin, so welcome. I'm an accountant by day, and I'm a YouTube creator and investor at night, among having a wife and 4 kids and all that fun stuff that goes along with it. So thanks for joining me today. All right, so we're just going to jump right into this thing, and let me bring up the current stock price right now is $23. So we've kind of seen a fluctuation in the stock. Obviously, over the last month, it was all the way up to about $26.50. Now it's around 23. After earnings came out, it dropped about 2 to 3%. So overall, obviously, investors, hedge funds are not that happy about the earnings. But to be honest, they weren't actually bad at all. Keep in mind, this stock right now is shorted 17%. That is massive. So they have 118 million worth of shares. At least that's what they had at the end of the first quarter. And almost 20 million of those are shorted. So this stock right now is very, very suppressed. Once it starts moving, and I think eventually it will start moving up, a lot of those shorts are going to have to cover, their costs, and the thing's going to go up very, very quickly. That's my opinion. It's not financial advice. It's just that's my personal opinion. I think that's what's going to happen. All right. So let's take a look at the earnings real quick. And I went through and I highlighted some things to talk about. I'm not going to go through the whole thing. There's just kind of the Cliff Notes version, I guess you could say. All right. So their net sales were $1.5 billion. So keep in mind that 2020 was a complete anomaly, obviously for the country in general, but especially grocery stores like Sprouts Farmers Market. So keep in mind that all of a sudden, when the whole Rona situation happened, people were staying home, they're working from home. People are not going out to restaurants either. The restaurants got closed down, or people just didn't feel comfortable or safe going into those. And so the grocery store saw a massive uptick in 2020. So it is not fair to compare 2020 quarter 2, even quarter 3 numbers to 2021. And Jack Sinclair, the CEO there, has talked about in previous earnings calls, got to be careful about some of this comparison, especially in second quarter and third quarter overall. So it's not surprising that there was 7% decrease. Now, keep in mind that they missed on the top line. So they were supposed to be around $1.6 billion. So it was about a 4.5% miss. So not a big miss. Now, they did beat on the bottom line, which we'll get to here in a second, but just keep in the back of your mind that they should have a decrease from year over year because of the Enigma anomaly that we saw in 2020. All right, so comparable sales growth was down 10%. Now, I will say that is one of the elephants, I think, in the room with Sprouts. Historically, their comparable store sales aren't fantastic. You're talking a lot of the years they're around like 2%, which is not good. And we'll talk more about how they're restructuring the company in a little bit, how Jack Sinclair came in the last 18 months and is really changing the way Sprouts is going to be running into the future, and it should boost some of their comparable sales overall. All right, so net income was $61 million. They beat analyst expectations by 15%, so that was really good. Now, for me personally, and Jack Sinclair said the same thing, it's not fair, again, to compare 2020. It's more fair to compare 2019 numbers to see where they were at and see what happened in 2021. So they're at $61 million for net income 2021 second quarter compared to $35 million from 2019. So that is more of a fair comparison. And so let me just do a quick calculation right now. So that's 61 divided by 35. And that increase is 75%. So that is a massive uptick that we saw over the last 2 years. So that is a really good thing going forward that I think that we'll see from Sprouts. So diluted earnings per share, 52 cents for the second quarter. And that was compared to 30 cents from 2 years ago. So they're going in the right direction overall. All right. And keep in mind that when I listened to the earnings call and they talked about this in the guidance as well, which I think we have down here. Yeah, here we go. All right, so they actually increased their guidance as far as where they think they're going to be for earnings per share for 2021. So keep in mind they're around $2.40 EPS in 2020, which was a much higher amount than they normally would have been. You can make an argument maybe they would have been between maybe $1.50 in 2020, and now they're saying they're going to be at $2 for 2021. So if you remove that $2.40, that was Enigma, and 2020, this is actually a solid number. And the reason why they raised this low for 2021 is that they're doing a huge share buyback program. So they're planning to buy $300 million worth of shares. I think I saw that they bought around $100 million worth of shares, something like that so far this year. So that's increasing your shareholder value. So that is tremendous. And keep in mind that, right now the stock is around $23 a share. If they're going to be at $2 a share for EPS, this stock, in my personal opinion, should be trading between $28 and $30 right now. I think it's, what is that? A margin of safety, is that 30%? Let me calculate that real quick. So we'll say $30 divided by 23. Yeah, it's exactly 30%. So I think right now, the margin of safety from their fair value is 30% right now. And a big reason why, again, that the stock price is suppressed is because it's shorted. A lot of people don't believe that Sprouts has the type of growth in front of it. They're kind of comparing what they've done in other years, which actually has been pretty good. But because of what Jack Sinclair is restructuring the company, I think that's going to catapult them into the future. And this thing right now should be a minimum fair value of $30 a share. Now, if we go take a look at their balance sheet, there we go. So current assets, and I'm really looking at cash right now. So they have $221 million of cash. And if we take a look at their long-term debt, which is down here, $260 million. Now, what I like to do is I like to figure out how quickly can they pay off their long-term debt based on their free cash flow. That gives me a good idea how well the company's run, how well structurally they are assets versus over liabilities, and how quickly they pay their debt off, right? So if we take a look at their free cash flow, they had $177 million cash from operations the first 6 months. So we subtract out CapEx, which is about $40 million. We'll say roughly $137 million of free cash flow for the first 6 months of the year. So if we take that $134 million and we multiply that out for the remainder of the year, we'll say that's around $270 million worth of free cash flow. They had about $260 million of long-term debt. So they could pay that off within 1 year. So that is really good. If they could pay off 1 year, I look at that and say they really don't have long-term debt at all. That's kind of how I look at it. So they are in really, really good shape as far as cash and long-term debt right now. Now, if we go take a look at a transcript real quick, a big thing for me and the story right now for Sprouts, actually, let's talk about that. So if we take a look at their 10K, all right, so their 10K, if you've never read a 10K, that's basically the annual report of a company. And really, if you're interested in a company, I highly recommend going through and reading the whole thing. It kind of gives you an idea of kind of where the company was that previous year, but a lot of times they'll have some really good information on what they want to do going out to the future. And I really look for companies that have management teams that have these big, hairy, audacious goals. I just did a video this morning on Dropbox, which they had this big, hairy, audacious goal of $1 billion free cash flow by 2024. Among doing other things, improving the gross margins and all that kind of stuff. Sprouts is kind of the same deal. They have these big, hairy, audacious goals from Jack Sinclair that they want to get over the next couple of years. And some of that is they're going to reduced their store costs for new stores by 20%. So right now they have around 360 stores. They're trying to get another 200 stores over the next couple of years or next few years. And they're reducing their footprint from about 30,000 square feet down to about 20 to 25,000 square feet, which we kind of see down here in this information right there, kind of talking about. So that reduces the cost by 20%, or reduced overhead going forward as well. So that should increase their margins. New store cash returns approximately 40%. At least 10% unit growth annually beginning in 2022, low single-digit comparable store sales growth as well. So that's what management team is saying. Hey, this is how we're going to determine how efficient we're doing going out into the future. And a piece of that is they completely restructured their marketing entirely, right? So what they did was, and I'm a Sprouts shopper. My wife and I shop at Sprouts every single week. They have the best produce of any of the stores that we go to, as far as comparing to like Kroger, comparing to Walmart, Safeway, any of those. Sprouts has the best produce, and a lot of times we can find it actually at better prices than some of these other stores as well, depending on the sales they do. But they used to send out flyers every single month, and what was happening and what they found, and Jack Sinclair said, hey, we're going to stop doing this, is that they were getting basically people getting into their stores just to get those loss leaders, what they're called. So they get in there, they see, hey, corn is 4 for $1. They just buy the corn and they leave. And what a loss leader is, I worked in retail for about 10 years, is you're trying to get people to come into the store to buy these products that are really cheap. And a lot of times, actually, it may cost the company more money than what they're selling it for, hoping that they're going to buy other stuff in the store. And what they were finding is that they're getting these customers to come in buying the loss leaders, and they're not buying anything else. So they're actually having a negative transaction that's going on, and is hurting the company. So sales might be more, but their bottom line is hurting from that. So what they decided to do is completely stop sending out flyers every single month, and instead they are just allowing the customer base that understands them, knows them, come in and then buy what they're normally going to buy. And they still have sales on in the store, but they're trying to target a specific audience, right? And so we're seeing this change, and they're saying we'll probably see more of it in 2022. They're really saying 2022 is when they're going to see a lot of these great things that they're doing all kind of come together. But one piece of it is they actually restructured a store in Texas and also in Phoenix as well, and remodeled those at a smaller scale to see how the customers liked it, because they're planning to, and actually you can show the PowerPoint presentation. They're planning 13 to 20 new stores in 2021. This is a growing company, growing company. And 3 of those stores are going to be at the smaller footprint. So it's going to cost them less to build and going forward as well. And so I want to know really how well the customers are responding to this. So I listened to the earnings call, and let me pull up the transcript for that. Where did it go? I have it up here somewhere. All right, there we go. All right, so one of the analysts during the Q&A asked Jack Sinclair, hey, how are customers responding to these 2 new stores that you just remodeled at the smaller footprint? What can you tell us? And this is what Jack Sinclair says. He says, well, the Tustin was a little bit of a remodel, Scott. As you know, the new one that we opened in Phoenix, which we are very excited about, opened 10 days ago. So fairly new overall, but we are encouraged by the customer reaction to the changes. So encouraged by customer reaction right here that we made in Tustin. We got a lot of positivity. The encouraging thing for me with regard to this is the way customers are saying, well, I thought you are now building smaller stores, but it feels bigger. And that's certainly feedback from Phoenix store, which we built at 23,000 square feet. And the people in Phoenix know our business well. They actually think the store is bigger. So that's encouraging in terms of going to that. It's too early to say in terms of the absolute level of the number. So at least it's obviously new. They're still trying this out. It's only open 10 days, but they're getting a lot of positivity. So that's a really good thing. As a shareholder, I'm looking to see customers are responding positive to this overall. Now, they are also changing up their marketing. Last year was the first time they've ever run commercials out there. And so, Jack Sinclair, and I've talked about in previous videos, but he came from Walmart. He actually is the one who designed and was in charge of the whole Walmart grocery section, right? And so this was a phenomenal hire by Sprouts, bring this guy in. He knows grocery really well, and he is, in my personal opinion, really restructuring the company in a way that they still should be able to get the same amount of revenue, but they should be able to cut down on costs going forward. They also opened up a new distribution center in Aurora, Colorado, which is my hometown. They did that last year. So it's kind of crazy to see that they did that just nearby me. That's also a positive thing. Not only that, but the way they're set up right now, their distribution centers can handle up to about 500 to 550 stores. With the new stores coming on board this year, they should still be around less than 400, so they could still have room to grow overall. So they're still in really good shape. So this is kind of what my final thoughts about Sprouts is right now. So as of right now, I think they're 30%, less margin of safety of what they are as far as fair value. And even when they get to that fair value, which I think they'll get to at some point, I don't know if it's a year, 18 months, 2 years, some point they'll get to that. This is not going to be a world beater stock where they're going to, get 20% return for shareholders. I don't think. The share buybacks obviously are going to help. They're buying back about 10% of the entire company, which is going to help. The reduced profits is going to help. But, this is something that's probably going to be, maybe, 15% rate of return, still being in the market long term, in my personal opinion. But I like where it's going. It's a smaller position on my portfolio. I like it being in there. It really comes down to management and the story. I always want to know what the story of the company is, and if they can execute at a very high level, a lot of times you can actually get a higher return than what you're expecting. So we'll kind of see. I bought some more shares this past week of Sprouts. Certainly, if it's under $24, I am a buyer of this stock. So love to hear from you guys. What do you think about Sprouts? Do you own Sprouts? What are your concerns? What are your questions? I look at all the comments down there and try to respond as I can. Love you guys so much. Thank you for watching. I'll catch you guys on the other side. Take care and God bless.